Okay, all right. Hello, everyone. It's me again. And today we're going to talk about financial independence and ways of investing. Why this topic? As usual, why? Well, I thought it would be quite interesting actually to discuss like why would one even want to start investing? It's so much risks and pressures, and you need to actually know so much things, not just about the markets and like what's going on in the world, but also about how to analyze the company, how to assess their performance, their profitability, like what will happen in the future and everything. Also, another question to ask, like, how can you even invest? Do you just like buy, I don't know, stocks of Apple, or do you buy a bond, or like the portfolio, the investing, how is it happening? Well, these are the questions that I personally met with, and well, honestly, I wouldn't say that I already have an answer for them. I'm still, let's say, in my journey of exploring things. But yeah, well, who knows? Maybe this video will change something. Maybe I will find some more ways just for me internally. But, anyways, I'm going to discuss two main strategies of investing, and first one being passive investing. Well, in short, uh, passive investing is like kind of a long term strategy, mostly focused on buying indexes or funds like S&P 500, for instance, which kind of just made the market returns. So it's already more than if you just save your money or put them in your bank with like small return percentage, I don't know, like 1.5, whatever. It's already more, it's about 10-15% sometimes, I would say. It's the market return that you're gaining if you're investing in S&P 500, for instance. In passive investing, you don't really need to pick out individual stocks of companies or other securities like bonds or whatever. Basically, you invest in an index like S&P 500, which S&P 500, for instance, it's like 500 different largest and most significant companies from absolutely different sectors and different types of businesses, and they kind of, by buying an index, you kind of diversify your portfolio already. Like, you don't need to work out the way what is like your desired level of, I don't know, loans, so like debt instruments, what is the level of commodities, so like gold, for instance, or silver or oil, what is the level of equity that you own, so shares or stocks. You just buy the index, which already contains all those things and ones, and even when there is like a crisis, and I don't know, like a COVID, and or not the COVID, let's say the Russian-Ukrainian war, the oil prices go up. I guess they do go up for Europe tremendously, and oil companies do benefit from that. But then airlines, who do depend heavily on the oil, would suffer because their costs would increase. But if you buy an index, you already, like, this index already creates this negative correlation between stocks, and you do not need to be worried that all your assets are in Ireland, for instance, and all your stocks are just like all the securities that you own are crushed. Like, index already thinks about it instead of you, and you have your market return. It is, well, rather low cost and low risk, as I said, because it's heavily diversified. And you kind of just see it, you buy and hold it, and it's more of a strategy, like, to wake up one day retired and happy in Sicily somewhere with a cup of whatever you prefer to drink in the morning, and thinking, yeah, I still got some money in my pocket. And the second strategy is active investing. So, well, quite the opposite of the passive, logically speaking. The active investing is more of that investor would buy stocks or bonds or other securities, quite actively, they would create their own portfolio with their own kind of, not the measurements, but parts of their portfolio. For instance, some investors would like, I don't know, 50 debt, 50% equity, or some other division of the securities in their portfolio. And basically, they would make, and not just make the market returns, but they generally outperform the market returns by kind of playing on the price changes. So you basically make money when you buy a share, let's say, of a company for 300 euros, and tomorrow you sell it for 400. And these 100 euros difference, it's your return basically on your investment. So you don't hold like a stock, so it will pay you dividends or that it will increase in price after 20, 30 years. You kind of don't do that. You exploit the market inefficiencies, the price changes, and everything like that. But yeah, of course, it does create, like, if done correctly, it does create like huge returns. There are some people making 100% return on their investment. So you invest like 100. No, I will not do the math today. I did it too much already. So you just have a way higher returns. But active investing would imply that you need to find the company, go through all their financial information, do some KPIs, some like what is their earnings per share EPS, what is their return on equity, on assets, net profits, what are some discontinued operations, what their proxy statement says, who's the manager, who are the management team, the board members, committee, like all the information, like all the hundreds, like some statements would have just 100 pages, some up to 300 pages, and you kind of need to read through almost everything to understand like the actual background of the company. And then you still need to understand the market quite well, in my personal opinion. Like, there are some people who say that no fundamentals, so only the financial statements matter the most. Some people would say no, the macroeconomics and the market would mean more than just the financial data. At this point of my life, I kind of feel that it's very important to combine both. Like, if you understand the market trend, how other people, how investors or the market or society pursues the company, for instance, do they think that the company is stable, or do they think bad of it, or whatever, you would need to analyze that, see some geopolitical or just political influences, like what's going on in the world. And based on that, you would make your investing decisions. And based on that, you would need to always be up to date and change your portfolio over time. With funds or indexes, you do not need to do that because it's already kind of done by the fund whose indexes you're buying. But for active investing, you're managing it by yourself fully. And here, well, I both arrived to my conclusion that you are the one to choose. But in my opinion, it's very important to understand that, well, financial literacy is not just about, counting your spendings and saving up like 10% of your earnings. When it comes to investing, it's really a hard work to do, and many people do learn on their mistakes, of course. But, well, me personally, I don't feel like losing another 1,000 euros just by investing in the wrong company. And sometimes for 1,000 euros you can buy just one stock of like one share of a company, which is crazy. And then it goes down immediately and you just lose all the money. So if you don't have this financial literacy and the actual understanding of what you're doing, well, financial freedom might come not this year, not the next one, and might not come at all. So it's all up to you to decide like how risky you are, and whether you have enough internal inner strength to do these decisions. So thank you, and I see you next week.